predictions for 2025 and beyond. One of the most complicated aspects, especially when it comes to economics, is being able to know what will happen in the future. There are many events that take place in the economy, and even more so in today's economy, an economy that is not only influenced by internal developments, but also by everything happening around the world. We are seeing an economy in the United States led by the Trump administration that is trying to look inward. However, all the external events that are happening distract attention from that trade, because in the end, international trade is what sets the pace for domestic trade. What's happening with the housing sector? The housing sector is affected by everything that's going on. So, making predictions is quite complex. But today we're going to bring you the opinions of 100 economists who are reviewing what's happening globally in order to understand what could be happening in the housing market and what the coming years might look like. As a heads up, and this is a spoiler for those waiting for a crash, a drop, something to break the housing market just because home prices went up and so they think they'll come down. It's not going to happen. We're looking at a market that seems very solid, showing much more stable growth, and with interest rates coming down, as we already saw in the first days of August, and it looks like in September too, and it's inevitable that the Federal Reserve, with all the developments we'll discuss today on the podcast, will lower interest rates. There's going to be an acceleration. However, inventory is going to be key. If there aren't enough homes, prices are going to tend to rise. So today we're going to analyze how inventory is looking. Are there enough new homes and enough existing homes? Is the market stocked enough to handle high demand if interest rates go down? We'll go over all the numbers transparently, as always, because we're the best real estate agents in Florida when it comes to looking at numbers, reviewing what's happening in Spanish so you can have first-hand information and make smart decisions, always with plenty of information, and so you can get great returns on your real estate investments or when buying your home. As always, I'm Gabriel Perozzo, and I'm here with my friend and business partner,
Jen Zamorino. It's a great pleasure to be with you all today.
Jen Ike. That was a bit of a long introduction, but today's economy is pretty complex. It used to be pretty simple. Build houses, sell houses. Nowadays, we can see that the tariff war has turned into a global movement where every country is making its own moves. However, what's going to happen within the United States? Those influences, those tariffs, it seems like we're already seeing the first benefits or maybe the first drawbacks of what's happening. But what are economists saying about the housing sector? Are we optimistic or pessimistic?
Look, what you just said is actually positive. And to add to that, the world of real estate right now is based on, or has always been based on, the economy. And because of all the upheaval that's happened, really, the first thing we need to do is look at all the economic indicators to try to figure out where the real estate world is headed. That's why Fannie Mae conducts a survey, and the survey is of 100 people, 100 economists who know the real estate world, who study the trends, who analyze the metrics, and they ask different questions to try to forecast where property prices are headed over the next 5 years. They do this on a national level and use national averages. So, what does the Fannie Mae survey say? First of all, there are several charts, and they divide the 100 people into two groups, the pessimists and the optimists. Then they take an average of their opinions. What do the pessimists say? Here they show the price increases starting from 2025 through 2029. The pessimists start off saying there's an increase of 0.6. Then in 2025, it's 1.6. In 2026, 3.2. 2028, 5.6. And in 2029, 8.3. The optimists, who think everything will be fine, say, okay, 2025, 5.2. 2026, 11%, 2027, 17.8, 2028, 24.3, ending in 2029 with a cumulative increase in property value of 31%. What does Fannie Mae do? They take an average and say that the average of these two groups gives us 19.5, and this refers to the increase in property value. Here are the numbers I just mentioned. This too is what is expected. And they also give us an average of how much it is. If you break down this increase between pessimists and optimists, it says that the average is 3.7% annually. The increase for the optimist is 5.5% annually up to 2029. And for the pessimist, it's 1.6. But what happened before these predictions? And they give us a bit of history here. They tell us that before, from 75 to 99, before the bubble, during those 25 years, the average annual increase in property prices was 5.1%. Then, during the bubble, it increased to 7.7. The bubble burst, and during the period of the fourth chart, and from 2006 to 2012, there was a decrease in property values of 4.8% annually. After the bubble, we saw an increase of 4.5. Pandemic, 9.5% annually. This story is shown to us here. It's graphed in bars simply so we can evaluate where things have gone after the economic shifts. After the bubble, which we could say came after the bubble, 7.7, there was a decrease of 4.8. We're not seeing it here. We're not seeing reasons. Gabriel mentioned it in the introduction. Inventory. We don't have the same oversupply that there was during that time. That's number one. And number two, back then there were problems with mortgages, with poor mortgage ratings, which is not the case now. Therefore, these increases, you could say 3.7, which is the average, is something normal within expectations and within this range of price increases. The next chart we can see is a scatter plot. I find it very interesting because it shows just how differently these 100 economists think. So the higher the percentage, the greater the polarization or the more varied the opinions. And there are three questions. Number one, mortgage interest rates. Number two, the increase in property value. So we have mortgage interest rates in light blue, and notice that the spread is around 6.5. That's where they have the most differences in opinion. And we come back to the point because of the economy and because, well, we really don't know what's going to happen. It's very hard to predict what will happen with the economy and therefore also with interest rates. The increase in prices. Notice that the difference in their opinions is just 3.5%, which means that one way or another, they think similarly. Maybe their projections are different, but both pessimists and optimists think prices are going to go up. So these are really the predictions. We know that making predictions is bold, that making a prediction doesn't mean it's 100% certain, that even if there are 100 people here, 100 people who study the field and them, it's something we always recommend. You need to go to someone, first of all, who is in the niche where you want to invest, who is in the local market, and on top of that, the economy can change and anything can happen.
Yes, we see those super complicated predictions. But what we can be sure of is being able to study what's coming in the next semester of 2025. What's going to happen from August onward is much easier to predict because it seems like everything is pointing to inventory slowing down. Let's look at the study, which says inventory is above pre-pandemic levels in these 80 real estate markets. That's good news for home buyers. Indeed, inventory has gone up. Here we can see in January 2025, just 8 months ago, 41 out of 200 markets were already at pre-pandemic levels. Then the numbers kept increasing. 41, 44, 58, 75, 78, 80. What I want to point out is that the speed at which inventory is increasing has slowed down. We went through months where, as you can see here, 14 metropolitan areas were growing month by month. Here you can see that about 11 metropolitan areas were growing, but here it's down to about 6, here only 3, and here just 2. In other words, the inventory growth curve has come to a halt. All the specialists we're reading, Housen, Weir, Logan, Lance Lambert, who are the ones who study the numbers the most, and Alto's research, are all concluding that we've reached the inventory peak in July. Normally, this would happen in August. In July, we hit the highest inventory peak, and now we're going to start seeing a decline. If we look at it now, let's check it out here in this chart by cities. We'll notice that there are cities. Let's use simpler examples. Let's take Texas, for instance. If we look at the cities in Texas, we'll notice that the first city that comes up, let's look at Austin, Texas, the Austin metropolitan area. It's at 13,000 housing units. That is 64% more than in 2019. However, notice how the inventory started to grow. This column right here is 2023. We had 8,500 units in 2023. Then we jumped to 11,000 and then to 13,000. Notice that there's a slowdown from 23 to 24. They went up quickly, but from 24 to 25, they're increasing more slowly. This suggests that the magic price point might be coming to an end. There is already some level of negotiation, but it's not an intense level of negotiation. Prices shouldn't be dropping any further. Why? Because inventory, always remember, is what sets the prices. If we analyze areas in Florida, for example, let's look at the main metropolitan area that shows up here. Look, Cape Coral. Cape Coral grew by about 4,000 units from 23 to 24. But from 24 to 25, it only grew by 3,000. In other words, the curve is dropping once again in Florida's metropolitan areas. And there's something. People think inventory can grow without limit. Folks, there's no way inventory can grow endlessly because we're talking about a finite number of houses. I mean, houses don't just magically appear. You can't just take a house and split it into 2, 3, or 10. The number of houses grows based on how many sellers need to put them on the market. Let's analyze with Jenny how this whole housing situation is working. Why? Because this whole inventory issue that we can see here, and in a moment we'll analyze this chart, is directly related to whether sellers are motivated to stay in the market or not. Houses come onto the market, but just as they come in, they can either be sold or the seller might simply decide, I don't want it on the market anymore, and pull it off because they don't want to negotiate, for example. So inventories don't rise drastically unless it's due to new construction. And it turns out that new construction, which we'll also analyze, isn't growing either. Here we're looking at exactly how. From July 2024 to July 2025, and it shows us a bit about the growth rate. For example, we have Punta Gorda, which in July 2024 had 76% more inventory than before the pandemic. Right now, it has 106% more. But we can see how in many of these areas, we're talking about 200, the acceleration goes from negative to positive, but not by too much. You can see the line between the 2 points isn't very big, which means inventories are growing too quickly. We'll have to see what happens. For me, the key point is called inventory. People talk about price, interest rates, but inventory sets the tone. Inventory falling, inventory going up. Prices don't move. Jenny, it's been a somewhat turbulent week because the drop in interest rates, even if it's just a few points, has led to movement in the housing sector. Tell us how this past week has been and what Redfin is seeing for the future.
Yes, look, I have an article from Redfin that says, buyers take note. Mortgage rates are falling. Home price growth is cooling off, and supply is outpacing demand. In many areas, inventory is certainly stagnant, but in others, it's increasing. So where we have excess inventory, prices are one way or another actually going down. Now, what's happening with mortgage rates? It says the average daily mortgage rate dropped to its lowest level in almost a year. A buyer with a budget of $3,000 has increased their purchasing power by $20,000. That is, the value of the property they can afford today is $20,000 higher thanks to the drop in interest rates. And that translates for you into a better property, a bigger home, a better neighborhood, or something closer to what you're actually looking for, most likely. So this drop in interest rates is a huge help for you as buyers. On top of that, the increase in housing prices is actually very low. I'll show you in a moment. I'll show you below how much home prices have gone up further down in the article. But in addition, there are more sellers than buyers in the housing market right now. It says that the total number of homes for sale has increased by 8.5% year over year, while pending sales have dropped by 1.2%. That means more units keep coming onto the market, but far fewer are being sold. Because of this, we have a lot of sellers looking to negotiate. So, as we always say in each of our podcasts, this is a time for negotiation. There isn't an excess of inventory. There really isn't. It's not overwhelming. So maybe the sellers, those who really need to sell their property, simply lower the price or offer certain concessions to make sure theirs is the one that gets chosen. When I mentioned prices, here the average listing price for properties nationwide is $400,850, which is a 2.3% year-over-year increase, and the average selling price is $396,991, a 2.1% increase. I wanted to show you in this particular graph. This comprehensive graph clearly shows me the new listings that are coming onto the market, and the year-over-year increase is precisely 0%. What does this mean? Yes, listings are coming in, but they're coming in at the same rate as last year. They are piling up, yes, because my pending sales are decreasing. By how much are they piling up? I have 8.5% more active listings, but I want you to look at the line. The line is trending downward. The line is trending downward because many of these listings, as Gabriel mentioned, simply don't sell. The sellers take them off the market, and that causes the accumulation to show a downward trend. Lastly, I wanted to show you this chart just so you can see the areas where the market can be said to be hot, which is the entire Northeast region. Our number one market is Milwaukee, where there is the highest number of transactions. In this whole area, property prices are increasing significantly, and in all these areas is where we see much more negotiation and property prices dropping. Really, this moment is a time, especially for those of us in the areas marked with blue dots, for negotiation and for you to go out and see. We always see that many clients, the showings, meaning the visits to properties, are increasing because the desire to buy properties in the market still exists.
Yes, Jenny, this morning, I'm quite active. I'm an active reader and an active commenter on things on Twitter, X, and I was reading news from the real estate world and something caught my attention, so I commented on it in that context. They were talking about that, about sellers pulling out. So what could be the reason? There's one reason that, to me, is fundamental and that any seller needs to keep in mind right now. Interest rates that are dropping or are going to drop, or negotiating myself and helping the buyer. If I'm a seller and I'm not in a hurry to sell my home, I wait for interest rates to go down. I pull my property off the market because I'd rather let the drop in interest rates help the buyer, so I don't have to help them qualify myself, whether that's by covering closing costs, lowering the price of the property, or whatever else. I'd rather wait until September or October, when interest rates are a bit better. The buyer feels more motivated because it's a better time for them. And as a seller, I don't have to make concessions. In other words, wait for the concessions to come from the economy, not from your own pocket. It's a different approach. And as a seller, if you can wait 3 or 4 months for this to happen, it would be pretty smart. That's why a lot of sellers at this point say, Let's wait for the economy to be more favorable to buyers, so I don't have to be the one competing with many other sellers who ends up having to help that buyer.
Right, that's true. But here's the thing. The properties that are still on the market and haven't sold yet are actually an opportunity for buyers, because it means that one way or another, that seller needs to sell, whatever the reason may be. Whatever the reason, they need to sell. So probably for you as a buyer, it just makes sense to go out and buy now.
Sure, but that's not a but, that's an and. I mean, it's not. Look at what's happening with the seller, but it's look at what's happening with the seller and.
Yes.
This is what happens with the buyer. What I want is for you to see that these are two different scenarios. It's the buyer's perspective or the seller's perspective. It's not the same perspective. Seller. I'd rather pull out of the market. Buyer. I'd rather get in because the one who's left is wounded. Right? Remember, in this market, it's like the gazelle and the lion. Every day, the gazelle wakes up saying, I have to run faster than the lion, faster. Right? And the lion says, I have to run faster than the slowest gazelle so I can eat. In other words, some have to avoid being eaten, and others have to run fast to eat. That's how the market works between buyers and sellers. Let's look at new construction, Jenny. Interesting. And it says, new constructions are a bit worse than what the public housing builders are letting on. This is coming from the CEO of the country's largest building materials supplier. It turns out that here, in this study, in this report, the director of Builders First Source is speaking. This is the company that supplies the widest range of materials to all the builders in the country. So they know what the demand for materials is like, how things are working, and they're planning for what's coming. He spoke from different points of view. Jackson says there's an inventory environment, and that what we're seeing in the land market, we're also hearing about demolitions and contracts. We believe that builders are slowing down the pace of construction. So, in general, they feel that the pace of construction is slowing down. Several points he considered, and I want to share them with you. Home completions are increasing after the boom. What's going on? There was a boom in permits. Builders injected a lot more housing units, and here we can see it. In multifamily, the number of permits is close to 500,000 permits that exist at this moment. They were seeing that multifamily buildings with 5 units or more, in terms of starts, how many units are actually getting started? You can already see it's less than 500,000. In other words, more permits are being issued, but not all the permitted projects are actually being started. And then, when we look at completions, you can see how it drops here, and multifamily completions are around 400,000 units. So, a lot of permits, a little fewer starts, and much fewer completions. The market is slowing down. What are they seeing? That an excess of inventory can hurt their sales volume, and the builders are responsibly putting on the brakes. Single-family home construction is slowing down. Now we're not going to look at multifamily, but at single-family housing. We're seeing around 900,000 permits being issued right now in 2025. You can see how this line was going up. Here we hit peaks in 2021 to 22 with all the incentives that were in place. But now we see a decline at the permit level. Then we also see construction starts going down. And when we look at completed homes, we're also seeing a drop. In other words, for single-family homes, all 3 categories are declining. They're requesting fewer permits, starting fewer homes, and completing fewer homes. The timeline is shrinking. They know that injecting too much inventory is harmful, and they're seeing that in the market. It also depends on the area. Remember, places like Texas and Florida have an excess of new home inventory, and that's why builders are offering a lot of incentives. So if you want to buy new, this could be a good time to reach out to us, so we can tell you where you can negotiate and what kind of deals you might be able to get. Next, construction employment. which is incredible because it's one of the factors that determines the possibility of a recession in the near future. When construction drops, you can see here, drop, recession, drop, recession. This gray line represents a recession. Here you see a drop, recession, and here it hasn't softened yet, but you can already start to see a slight decline. This is direct construction, and this is specialized construction. That is, there are about almost 1 million workers who work directly with the construction company, and around 2,250,000 who work with third parties specializing in things like roofing, drywall, electrical work, plumbing. Those are the ones connected to third parties that serve the construction industry. We're seeing how these lines are starting to smooth out. This could be the beginning of a possible recession, which could lead the Federal Reserve to lower interest rates to jumpstart the housing sector again. And that's what we're likely to see in the near future. And finally, the inventory of completed but unsold homes from builders has reached its highest point since the global financial crisis. What are we seeing here? Here we're seeing they have created an index where they divide the number of new homes for sale that are under construction or completed, meaning those that are in the ready stage, by the number of homes that are being started. What does that mean? They're looking at an index that tells them whether the market is cooling off in terms of construction volume or if it's speeding up. We can see that we were coming from a period here where things were really accelerating. The market was very tight, and then it started to cool down. In other words, inventories have been consistently rising and housing starts were also consistently increasing. But what's coming next is a decline because the builders are seeing it. So, I want you to have first-hand information about what's happening in the sector. Additionally, there's a very interesting survey about what the players in the housing sector are feeling. Here, they interviewed 423 adults in a housing sentiment survey. 80% of those interviewed were homeowners, 17% rent, and 3% live with relatives. What are they seeing in terms of sentiment? In terms of sentiment, they're looking at what interest rate they would accept to buy their next home. We see that the turning point starts at 6%. In other words, we're very close. Remember, we'll look at interest rates at the end of the podcast, but right now we're at 6.57. And here we see that by 2025, the third quarter of 2025, 52% already feel comfortable with a 6% rate. We're at these levels, meaning that at 5.50, it would be 66%, but we can see how it jumps from 28 to 52, but here it doesn't jump by the same amount. In other words, the magic rate right now is 6%, and we're just 0.5 away from reaching that. And here it has increased. This shows how people felt in the first quarter of 2025 and how they feel today. If we keep looking here at what they expect rates to be over the next 12 months, they think it will be between 6 and 6.5. That is, 46% of those surveyed say it will reach the magic point in the next 12 months. So, in the next 12 months, it makes us think that those people will definitely enter the housing market. Additionally, here we can see what they expect for the next 12 months regarding price. As for price, they expect prices to go up. Like you said, Jenny, the prediction here is actually coming true, not among economists, but among regular people, and 33% think prices will go up between 1 and 3%, and 28% think they'll drop between 1 and 3%. But the trend that prices will rise is still dominant. If we look here, if we add 11 plus 33 plus 10, we see that more than 50% think prices are going to rise. A ton of data this week, Jenny. Numbers that are really helping us see a truly stable and positive market. There are important points. We're only talking about buying and selling, but what about the rental sector, Jenny?
Yes, look, the rental sector is very important because, well, it's basically the option for those who decide to wait before buying a property. That's number one. Number 2, for investors, if you already own a property and want to move and leave your property as an investment, it's really important to know where rents are heading so you can make the right decision. Because of this, I'm bringing you the National Rent Report from apartmentlease.com for August 2025. So, what is this report telling us? How have rents behaved year over year? And what it tells us is that average national rental prices have decreased by 0.8%. The national vacancy rate for housing has reached 7.1%. I'm going to show you the charts here so you can see them. After we saw an increase in 2022, 18%, 17%, 12%, a considerable jump in the rent rate, it's now going down, but it's been decreasing since 2023, since the 9th month, since September 2023, and has been moderately declining year over year. If you look at the decreases, it's minus 1%, minus 1%. It stayed there, and now we have minus 0.8%. Additionally, what has the value been? On average, it's $1,400 for all types of units, 1 bedroom, 2 bedroom, and more. I truly think this particular point is exceptionally relevant, especially when you are diligently trying to conduct a comprehensive analysis for a potential investor. We always pay very close attention to the current vacancy rate within the specific area because that crucial metric will absolutely ensure that my valued investor, or indeed the individual who is genuinely considering purchasing, will have their acquired unit successfully rented out for the vast majority of the time, providing a consistent and reliable income stream. In this case, we see that in 2022, at the national level, the vacancy rate was 4%. It has increased considerably, and the upward trend is currently at 7.1%. And actually, right up here in the title, it says that the national vacancy rate for multifamily housing reached 7.1% this month, setting a new record for the entire index. This is a new record. There is vacancy. You have to make sure your apartments are competitive when entering the market. Another number that I find quite important is the average time it takes for a unit to be rented. And this sum I want to show you here so you can see the cycles. We have January with 30 days as the peak, January 2024 with 34 days as the peak, and January 2025 with 37 days as the peak. January in itself is a month when units take longer to get rented, and the peaks, or when they rent faster, we're talking about June. As we've always said, it's seasonal. The market, both for buying and renting, moves in a very similar way. Today, we're at 28 days. If we compare it to last year, it was 26 days. So it takes a little longer for a unit to get rented. However, the trend in timing stays pretty similar. And finally, in this last chart we see, like we always say, we give the national average, but really each region behaves differently. There are places where rents are going down, cities, and others where they're going up. Let's start with where they're going down. The first city where rents are dropping is Austin, Texas. It's going down by 6.8% year over year. That's a significant decrease. Next is Denver with 5%, Phoenix with 4.1%, Tucson with 3.5%, and San Antonio with 3.1%. In Florida, we have Orlando with a 1.8% drop in average rent values. Where are they going up? Ironically, San Francisco for 0.6%. We know that San Francisco is a city with expensive rents, and they've been going up. Fresno, California for 0.6%. Chicago, Illinois for percent. Virginia Beach, 2.8%. On this map, we can see the hot areas and the ones that are really increasing, which are marked in red, and the ones decreasing are marked in blue. Rents, so for you, if you decide to wait before buying, here you can see where rents might be headed in the area where you want to buy or where you want to rent. And if you're an investor, these numbers also help you manage your risk margin and know whether a certain property is a good idea. Lastly, we always separate rents between apartments and single-family homes because single-family homes behave differently. We know they're much more convenient. And I want to share with you that single-family home rental prices in the United States increased by 3.1% year over year in May 2025. Basically, this number is what I wanted to share, and we always tend to recommend, if possible, buying a single-family home or a villa, something that's attached, that's much easier for a tenant to move into, or for you if you want to live there yourself. So really, that's our advice, Gabby. I know that now you have the interest rates that we all want to know about.
Yes, Jenny, let's get into the topic of interest rates. The issue of interest rates is complicated because we're stepping into the quicksand of what's happening politically with the Fed. Um, let's talk about that point first. There's something interesting here. Trump appoints Steven Mnuchin as the advisor, who is the chief economic advisor to the White House, as the one who comes in to replace Adrian Kogler after his resignation. Adrian Kogler had already spent 13 years at the Federal Reserve. Their terms are 14 years. He was supposed to leave at the beginning of 2026, but he decided to resign last Friday. Surprisingly, he said on Monday, "I'll work until Friday," to leave this position open so that Donald Trump could appoint someone and there could be a smoother transition than what has been that political battle between the Trump administration and the Federal Reserve. This was the key position Trump needed to get someone onto the Board of Governors. And once someone is on the Board of Governors, he could appoint them as the chair of the Federal Reserve. What's going on? That was supposed to happen in January or February. Now he had to make a quicker move, because now he had to appoint someone urgently to replace Adrian Kogler from today until early 2026. And then he does have to make a permanent appointment, the person who will be on the Federal Reserve Board of Governors for 14 years, and that person has to be confirmed by the Senate. So, the move is really interesting because it allows Trump to put someone in without the Senate having to confirm them. Why? Because they're simply going to fill the vacancy for those 6 months. However, this has served for Trump to start gauging who are the people he might see as candidates to be appointed next year. There are several candidates in the pipeline, and Trump is taking his time to see how these candidates perform and defend their economic positions in the media, in specialized forums, and in this way, he can have a much clearer idea of who it will be. For now, it's Steven Mnuchin. He has a doctorate in economics from Harvard, is Donald Trump's main economic advisor, and is a staunch defender of tariffs. One of the economic policies he has always defended as an economist is tariffs are the best tool a country has to manage, or that the United States has to manage, both the protection of its economy and its international relations. In other words, a dissenting voice joins the Fed, and in September, interest rates are expected to be lowered, but now he will participate in the vote. We had 2 votes against lowering the rates. Now there are already 3 votes in favor of lowering the rates. That is to say, the Federal Reserve is starting to measure itself differently. We can expect in the coming months, very likely, Jenny, that the successor to Jeremy Powell will be named, at least in the media, and that Trump will say, "This is my candidate." And that will cause Jeremy Powell to lose a lot of power, because everyone will be focused on who is being called Powell's shadow successor, or the shadow chairman of the Federal Reserve. Additionally, we have the spreads, which are the differences between bonds and interest rates. They have been stabilizing, Jenny. What has this stabilization led to? It's a 2.38. That's the difference between the interest rate and the 10-year bond, which is the benchmark bond for setting the rate. That gap has been narrowing. The historical average has been 1.80. Right now, we're at 2.38. It has been closing compared to previous years, which has allowed us to see rates like the one we just saw, 6.57. The market is anticipating the Federal Reserve's rate cuts. There's a lot more calm about what's happening in the economy, Jenny. We've received some interesting macroeconomic news recently. We also saw the European Union signing agreements. They're much more aligned now with tariff policy. We saw, for example, Apple saying it was going to invest $600 billion in domestic production. They're starting to win a battle that, when it came to tariffs had been going against them, with people saying it would be inflationary. Inflation hasn't hit, and additionally, both international and local players are starting to believe the economy is on the right track, and that's reflected in this very confidence. This week, there was a bond issuance. The bonds were sold with some difficulty, but they were sold at a good price. In other words, the macroeconomy seems to be on a very good path, and we're going to see fixed rates at 30 years, settling around 6.2, 6.3 by the end of the year, Jenny. That would be extraordinary for the housing sector as long as two things happen. We continue to have good inventory of existing homes, and builders, even though they're slowing down construction, don't slow it down so much that it causes a shortage in the market. How do we wrap up the podcast, Jenny?
Look, if you have any questions, contact us. Below is the direct link to our WhatsApp. The real estate market in the United States is very broad, and each micro market moves differently with its own inventory, prices, and trends, and the advice is totally and absolutely different for each one. So contact us. It's very simple. We try to bring you general information, but it definitely doesn't apply to you specifically. Contact us. We're here to help you.
That's right, Jenny. Thank you so much to everyone who watches us. Don't forget to give the video a thumbs up, which tells the platform it's quality content that should be shared. Share it and, of course, subscribe to our channel. We have 4 podcasts a week with the best of U.S. real estate. Where to Live on Miami Podcast. A production of Invest in Miami Real Estate. Total transparency.